Hi and welcome to Swissquote's Daily Market Talk. It's Friday, February 14th. Happy Valentine's Day, everyone. Investors are definitely seeing the glass half full these days and adding to their risk positions, but risks do prevail. Alright, so I'm sorry, but it won't be a Trump-free Friday show today because the new tariff threats, this time tit for tat tariffs targeting every country out there that imposes tariffs on the US imports, are dominating the news headlines around the globe. With one silver lining, though, is that studying the tariffs per case, or case by case, requires time, and the tariffs won't be effective until April, reportedly. Now, I don't know if you could call it good news, but the market's reaction actually suggests that that's been perceived as good news, and it actually helps keeping appetite afloat since yesterday. Now, the dollar index was sharply sold at yesterday's trading session, and that despite the broadening tariff war, despite the rising worries about the US and Russian negotiations about Ukraine, which, by the way, do not involve Ukraine nor the European countries that actually share the same continent than Ukraine, and also despite that mix of data that showed stronger than expected US PPI numbers yesterday and better than expected weekly jobs figures as well that would have normally supported the US yields and the US dollar, but did not. So, the US yields also eased at yesterday's trading session, and one of the reasons that could eventually explain at least a part of that weakness in the US yields and in the US dollar on normally dollar supportive inflation and dollar supportive tariff news is actually the fact that some of the components in the PPI report of yesterday that feed into the PCE index, the PCE index being the Federal Reserve's favorite gauge of inflation, well, pointed at weakness. So these items include healthcare and airfares, for example. But given that Jerome Powell himself told US politicians this week about his concerns about inflation in the US and how the progress in inflation has stalled since last year, I genuinely believe that a part of yesterday's sell-off in the US dollar has actually to do with investors closing the crowded long US dollar positions rather than a meaningful shift in the macroeconomic and geopolitical dynamics. Because look, the final German inflation figures that were released just yesterday actually printed negative, yes, negative monthly numbers in the month of January. And the Spanish figures will likely point at slowing price pressures in Spain in the month of January as well, while the Eurozone's GDP data that's due later today will confirm a no growth in the Eurozone in the fourth quarter of last year. And this combination of slowing inflation and zero growth could only back the idea of further interest rate cuts from the European Central Bank at a time the bets and the expectations for Fed cuts are being kicked down the road. Therefore, the weakness of the US dollar since yesterday will likely remain limited, and the strength of the euro against the US dollar will likely be topped. So from a technical standpoint, the euro dollar is actually testing the 104.60 offers that match the minor 23.6% Fibonacci retracement on September to January sell-off. And we do see a solid resistance into a distant 106 level, which is the major 38.2% Fibonacci retracement on the same time period that should distinguish between the actual bearish trend building since last September and a medium-term bullish reversal. But again, the macroeconomic developments and the geopolitical tensions are more supportive of the first scenario, where the euro remains in the bearish trend against the US dollar, where the Fed is slowly walking away from the interest rate cuts, than the second one, where we would see a bullish medium-term reversal. But in the short run, a soft-looking retail sales data from the US today, for example, could keep the US dollar under pressure, letting the US dollar's rally lose some more steam against majors. This being said, many traders out there will probably choose not to be short US dollar going into the weekend, simply because You never know. I mean, 2 days is a long, long time. Trump can say many, many things that could change things during a 2 day period that could eventually support the US dollar again on Monday morning. Now, speaking of the stalling European growth story, surprise good news came in yesterday from the United Kingdom. Yes, the British economy actually grew faster than expected by analysts during the festive month of December last year, which nicely boosted the services sector in the country, which is by far the biggest contributor to the GDP. And the British economy grew 1.5% last year altogether, which is much better than the 0.9% growth that the EU is expected to print today. But note that there's a but. So business investment tumbled in the fourth quarter in the UK, and that's basically very bad news for Rachel Reeves' government, who is, remember, supposed to be boosting growth, and you need investment for that. Instead, their tax rise plans are giving cold feet to businesses and to investors, and the spending plans don't see support from the markets as such. While cable's decent rebound yesterday could actually remain short-lived if the UK doesn't rapidly address these growth concerns. And topside in cable could actually be limited into the 126.50 level, which is the major 38.2% Fibonacci retracement on September to January sell-off. Now, of course, for both the euro and sterling against the US dollar, the US dollar's overall direction will be determining the overall trend, but sterling could actually still beat the euro on the back of a favorable growth gap in favor of the United Kingdom. In the equity space, though, the European stocks continue to surf on the rotation trade and disregard the tariff threats. The Stoxx 600 index rallied to a fresh all-time high level yesterday, while the FTSE 100 index in the UK also hit a fresh high but gave back gains and closed the session in the negative. Now, robust earnings and favorable European Central Bank expectations support the positive move in the European equities. On the individual front, the German champion Siemens, which generously contributes to the Stoxx 600 gains, while jumped more than 7% at yesterday's trading session after announcing a set of better than expected fourth quarter results, while encouraging earnings from Michelin actually boosted mood among the European car makers yesterday. Stellantis, for example, gained 4.5% at yesterday's trading session. Now, the company will report its earnings on February 26, but note that they had announced a 27% decline in its last quarter sales, to say that this convergence rebound is actually interesting, but the upside will likely remain limited by the gloomy fundamentals of the European continent that could, on top of all the financial and economic struggles of the moment, may need to find money to increase the military spending in accordance with the United States' new demands that actually warns that this transatlantic partnership is no longer working for offering security to the European continent for free. No wonder the BAE Systems rose more than 3% at yesterday's trading session, because the European defense stocks are certainly stepping into a new era. In the US, the S&P 500 flirted with the all-time high levels yesterday, and Apple added nearly 2% on news that the new low-price iPhones will be out as early as this month, and also on the news that the company will use Alibaba's AI technology to boost the iPhone sales in China. Alibaba, on the other hand, extended its rally to the highest levels in 3 years in Hong Kong on nascent AI optimism in China. And overall, the Hang Seng Index in Hong Kong this week has extended its own gains to nearly 20% since middle of January, on the same optimism that the inflowing Chinese AI models could be pivotal for the Chinese technology stocks that have been heavily battered since 2021 crackdown. If you ask me, I love the Chinese technology companies. And today, I am actually less concerned, less worried about the government's interference with the technology affairs, at least negatively, because with a worsening demographic and property crisis in China, along with deteriorating trade and geopolitical relations, well, Beijing can hardly afford another crackdown on its technology champions, because these are the last cards that Xi Jinping has left to play. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please do not forget to hit the like button on these videos to let us know that you enjoy them. Now, I will not be here for most of next week. I will see you on Friday, but I have actually prepared a few educational videos for you guys on your own request. So let me know your thoughts about these and let me know if you want other subjects to be covered when I'm not necessarily here, and I will see you next Friday. Bye.